this first ever panel webinar for the MIABC. Good day, everyone, from wherever you may be watching and listening these days, whether that be in an office, work from home, on a beach. You could be wherever right now. We've got some great attendance for this. It's still taking up. We're en route to trying to approach Helmet's record audience there. That was pretty fantastic. Thank you to everyone for the repeat attendees. Today, we're looking forward to covering a decent range of topics from where we've been to where we're at and where we are potentially going. We've assembled a breadth of lender perspectives for you all. Hopefully they will disagree with each other from time to time and have some polite Canadian banter during the session. Highly encourage it. If you have any questions, if the attendees have any questions that you'd like panelists to answer, please post it in the Q&A section on the side of the WebEx, and we'll try to either answer it in line or at the end for the panelists. So please let us know, especially if you have a particular panelist you'd like to tackle the question. Some of the panelists may be very familiar to you. However, I'll still quickly introduce them. Bringing his perspective from the high yield and brokerage spaces, Mr. Jim McPherson is the president and founder of Realtech Capital Group. Realtech's been in operation for over 40 years, providing brokerage work for larger existing and to-be-built commercial and residential properties. And also as a lender, providing non-bank financings for land and inventory projects, construction mezzanine loans, along with firsts and seconds on income-producing properties. Also, Jim is also just generally a really nice guy. Shifting gears a touch to Bill, well, actually everyone on the panel is a nice person. Bill Sherritt brings his perspective from the banking and credit union space. He's a director of community business and real estate for Vancity. With over 25 years lending experience, Bill and his commercial lending team support their clients with construction and term financings, amounting to $1.4 billion completed in 2019 alone. Bill works in the community on numerous professional and sports boards as well, also an avid golfer, and one day may be able to explain what truly qualifies for impact lending. Mr. Eric Clark brings his local and national expertise in analytics to this panel. Eric is a managing director of the Mortgage Analytics Group of CMLS, working to grow our collective understanding of the Canadian commercial mortgage space, and in addition, providing mortgage valuation services as well. Other than being a generally smart guy and a former WHL champion with the Vancouver Giants, he's also a good golfer and sits on a lot of important data. Myself, Graham Collings, I'll be your moderator today. Other than being a board member of the MIABC, I'm also an executive vice president of investments and a partner of ACM Advisors, a national conventional and conventional plus lender, managing over $3.2 billion for institutional and private investors. So I'll top up our conversation with some of the institutional and mid-yield perspective. Additionally, I'm a mediocre golfer, but in typical years, I do coach a lot of kids' soccer and baseball. All right, so we thought we'd perhaps start off here with kicking off the webinar with some statistics. Eric is going to take the lead now and take us through some of the aggregated information that his group at CMLS collects and digests for us. And so I see Eric's taking the screen now. Perfect. Excellent. Take it away, Eric.
Thanks, Graham, for the glowing introduction. Appreciate that. So as Graham mentioned, I work at CMLS. Most of the listeners on this call are probably familiar with the origination platform at CMLS, which did just shy of $6 billion last year and has a commercial servicing book of in excess of $20 billion. The group I head up is slightly has a slightly different mandate. Our primary services are market intelligence, so the research which I'm going to touch on today. We do independent valuation for a number of pooled mortgage funds and lenders, as well as software solutions business. So we have two products: Target Asset Management, which helps lenders understand the risk of their portfolio, and then a loan origination system called Atlas. In my unbiased opinion, is a market-leading origination system that's really helping lenders streamline their processing of loans. So with that context, I'll jump into our survey data. So we survey about 35 lenders in the Canadian market, which amounts to about 90% of all loans that are lent out during the course of a year, and we get pretty accurate information from that. as it's a good coverage of the market. So to give a bit of backdrop on the industry, we have it at, this is total outstanding commercial mortgages in Canada, about 317 billion. And you can see in this chart that it's grown steadily. Over the last year, it increased about 5%. To give context relative to the US, it kind of fits in with that 1 to 10 comparison, whereas the US is 3.5 trillion. We're about a tenth of that at 318 billion. There we go. To break that down into different risk buckets, so conventional makes up the bulk of that at 42%. That would be your loans that are around 65% loan to value, 1.3 debt service coverage. 30% is CMHC insured multifamily. Top tier would make up 14%. Those are what we call LifeCo quality loans, which significantly lower loan to value and less risk, those trophy asset loans. As you move up the risk spectrum, you have conventional plus at just over 10%, and then high yield loans, the most risky of the term type loans at 3%, which still makes up a market size of about $9 billion when you look at it. On the annual origination, so this would be new loans each year. You can see similar trend. The past year was about $62 billion, which is a significant increase. Looking at next year, that'll probably dip due to a bit of inactivity over the last 3 months, but we'll touch on that in a little bit. This chart shows how that origination is broken down by institution type. So you can see on the left that the banks are the largest group, and they've increased significantly in 2019. To the right of that, you have the credit unions. So this would be where Bill plays, and they've really been expanding their commercial mortgage book over the last little bit. Life insurance companies is the next. They've been pretty flat. NHA is your secured multifamily. So you've seen a big spike in multifamily insured product that's being lent out. That's partly due to a slowdown in the single family market, and that allocation is being taken up by commercial. The next one is private investment managers. So we have a couple of them on the panel in Graham and Jim, and that's an expanding group that's really helping to fund the market. CMBS, not a big portion of the market in Canada, much larger if you're looking at the US. And lastly, unsecured debentures. So this would be REITs and REOCs who fund their real estate acquisitions through unsecured debentures. And that's been pretty steady over the last number of years. So this next section is from our quarterly sentiment, which shows some interesting data when you look at pre-COVID, the Q1 where the COVID fear was quite significant, and then moving into June, how that looks or what lenders were thinking. So if you look at that first bar, that's the appetite from lenders to lend next quarter. You can tell that's Q1, which is right in that April timeframe where there was a ton of uncertainty in the market. The dark blue indicates an appetite to lend, and the lighter colors not so much. So you've seen a significant shift from the April timeframe to looking into June, July, where it looks like most of the lenders are picking up, ready to start that lending activity again. This particular one breaks it down. So it's not the same for every asset type. We have the four major asset types here. The bar on the left would be pre-COVID. So you can see office had significant dark blue, meaning a good appetite. Once the whole scenario happened and credit tightened up, you can see Q1, there's significantly lighter color. And that's held constant even through into July. If you look at the top right, retail, similar story. Even though before the COVID happened, there was less appetite due to e-commerce, and that's just expedited that to a certain extent. But the good news story on the lower half, industrial, where there's been a good demand for it. It slowed a up a bit, and then is almost right back to where it was previously. Same story with the multifamily. If you're looking at spreads, so there's been a big spike in spreads from what it would have been in the early part of the year, where you would have seen loans being done in the 170 spread over GOC for a 5-year term. That spiked up to over 300, kind of in the April-May timeframe. And what we're seeing lately is a strong downward trend. So spreads and coupons are coming in significantly over the last month or so. This data is a little old even now, but I would say you'd see more loans even coming in closer to that 200 range for top tier, low risk level loans. I'll skip this one because I can see Graham looking at his watch here. He's put me in a bit of a time box, but I'll move into the high yield pricing. So most of the lenders we interviewed in Q1 saw high yield moving up, as you would expect when there's uncertainty in the economy. Generally, there's a bigger risk premium necessary. That's shifted quite significantly in Q2, where you see a lot of downward pressure on those conventional plus and high yield pricing. And lastly, so missed payments or defaults. This is a general indication of what happened for lenders, and most were expecting a much worse scenario for missed payments, whereas payments coming in and defaults were less than expected for 3/4 of the lenders. About a quarter was in line, and very few saw worse than what they were expecting. This could be attributed to a number of factors that I'm sure we'll talk about. Some of the government programs have been effective, but moving forward, as some of them start to tail off, we'll see how steady the economy is as far as dealing with these debt payments going forward. So those were the slides. I'll stop sharing here and pass it over to Graham.
Okay, excellent. Thank you, Eric, for sharing the information. It's a lot of feedback that your group does across the country, grabbing that information. I know as a provider on the sentiment survey from our firm, always enjoy seeing what kind of comes back and what the other lenders all actually say on their reports. Also, like kind of calling out our industry for thinking that there's a lot more interest to lend on all asset classes quarter over quarter. But somehow a majority of lenders think spreads will remain flat. I don't know, seems kind of greedy, but then again, we are lenders. So, and then thinking about using that as a backdrop, I think Jim, Bill, if there's anything you guys want to touch on through some of the questions and lead back to that, feel free. I think from bringing it from a national perspective, bringing it back local a bit more for the more predominantly BC audience here. Perhaps I'll start with Bill to answer this next question with giving Jim the chance for a rebuttal. Hopefully, let's kind of lead off. It's overarching. It's been a highly volatile first half of a year on all bases. From a higher level, in your particular perspective, can you describe your deal flow volumes and some of the overarching characteristics that you've seen play out through 2020 so far?
Yeah, absolutely. I thanks for having me on the call today. I think Eric's slides provided a good graphic to everybody, but I think the first 8 months of the year can be broken down into kind of 3 sections. We've got, January to mid-March, where our deal flow was actually very high. The market was strong. We're off to a great start. I think all lenders had money to put out. We're starting to see some significant improvements in development opportunities. And for our group specifically, we in Q1 basically hit 6 months worth of our objectives. So absolutely great start to the year. Something happened in mid-March and things changed a little bit. And kind of March, April, May, I'd probably put those 2.5, 3 months into a bucket where the deal flow absolutely slowed. I think everybody put the pause button on. For lenders, really focusing on their existing portfolio, what impact COVID had on that portfolio, increasing loan loss provisions in anticipation of potential defaults and delinquencies. A tremendous number of loan deferrals were handled, the CEBA rollout, and also lenders just adjusting their lending guidelines, which we'll probably touch on a little bit later. So that's kind of where the FIs were at. For small, medium-sized business, they were looking at closing shop, having to pivot with their sales. Do we let our employees go? How do we manage our expenses? Where are we bringing our revenues from? So there was a big pause for small business, absolutely. And then obviously real estate investors and landlords in particular had to deal with their tenants and negotiating deferrals for rents for both in the multifamily, but also in mostly multifamily and retail space. A little bit of that in the office and industrial, but not a lot. Just jumping to June to today, I think the deal flow is actually improving. We're not back to pre-COVID levels yet, but Bonnie Henry's done a good job in managing BC's COVID numbers. I think we've seen the restaurants and hair salons and others opening a lot sooner than we probably expected. Businesses have done a good job pivoting. Bike sales, golf's been mentioned, gym equipment. Those businesses have actually excelled during this period of time. And I think the last 2 points that have really helped out, that 3-month pause we had, probably a bit of pent-up demand in the real estate market, and rates, as mentioned, are very low. Bonds dropped from December at 1.5-ish down to 0.35, give or take, for the 5-year bond. So interest rates are low, and that's providing a little bit of a boost, I think, to the market as we move into Q3 here. But I'll pause there and maybe pass it over to Jim to add his thoughts.
Okay, well, unfortunately, I can't disagree with anything you're saying, so we're not going to have any controversy here. In terms of volumes, our year ends March 31st. We had a great year, like everybody probably did last year, and of course, that was kind of coterminous with the whole start of the COVID, so we were very worried, and I thought, oh my God, we better hang on to all our money and not issue any dividends or anything like that because we're going to need it. What's transpired actually is we seem to be doing so far, knock on wood, just as well this year as we did last year, so that's all good. But what's happened is what we're doing has changed quite dramatically, and it wasn't very long ago that we were really fairly focused in terms of, I guess, the amount of revenue we got on high-rise condominium construction, and that business has largely disappeared. Somebody told me, I don't know if these numbers are accurate, but I was told a few days ago that pre-sales in 2018 were in excess of 17,000. They dropped to 7,200 in 2019, and this year it'll be a little over 2,000. So that's a dramatic drop, and we've done one high-rise this year. But there's other stuff that has kind of stepped in to pick up a lot of that, at least a lot of the activity in terms of what we're doing anyway. And the first thing is rental, which is largely CMHC driven, and the interest rates on rental, CMHC insured rental loans are really kind of unbelievable. I just checked this morning. We're out right now on quite a large one, $60 million or so, and getting quotes of 75 over government account bonds for 5 years. So that translates to, I think, 1.07 or something today. That's pretty cheap money. Even when you're looking at a 3% cap rate on an apartment building, you've got pretty significant positive leverage there at that kind of cost. So the other thing we're seeing on the rental side of things is, I think every developer is probably sitting on, soon to be or already shovel ready land for condominiums. They may be stalled out as far as that's going. So they are looking at whether they can convert to a rental project, and a number of them are, and we're financing a number of them. And again, CMHC has got a couple of programs which are, their RCFI program, which if you're successful in getting on board with that program, the cost of the financing is probably going to be certainly 1%, maybe even less than 1%. The draws are fixed at that, and you've got a 10-year term at that. So again, from a development standpoint, it kind of helps your numbers if you have that kind of financing. So, residential rentals has been a big part of what we're doing. The other thing that we're doing, while high-rise have kind of gone, townhouses have suddenly, particularly townhouses out in the valley, have come into their own, and for a number of reasons. One, the work from home is sort of playing into living outside of the core and not having to worry so much about getting into the core to work. Secondly, the taxes that the government imposed are obviously primarily on higher cost residences, so prices are lower out in the valley. And then the whole COVID situation where, elevators are one of the choke points for problems, and people are worried about, ground entry units. Kind of makes sense. So we're financing, we're doing mezz loans on a number of townhouse projects. And from a lender standpoint, they can do those with lower pre-sales. You can roll through the project. So you might have a 100-unit project. Well, you can start with as low as maybe 15 units and roll those out, see how it works, and carry on from there. So I think it's kind of the right condominium development for the time. The other thing we're doing, I guess the third sort of major area that we're looking at is what I would call repositioning loans. So some of these high-rise developments, they're obviously not prepared to run out and try and get pre-sales right now because they don't think they're going to be successful. But there's also some sentiment out there that there's going to be a lot less product coming to market at some point in time. So we do have developers who are saying, what I'm going to do is do some relatively modest financing, get the excavation started, maybe even get it up to grade, and get it positioned so that when the market comes back, and I think, the other thing that the market that is there right now is a homeowner market. It's not an investor market to the same degree it was. So the homeowners need to have certainty of delivery and delivery within a reasonable time frame. So even on a high-rise project, if you've brought it up to grade and now you're selling it, then you can offer prospective homeowners quite a bit of certainty in terms of the timing that you're going to be able to deliver a unit. So there's a few developers who are looking at doing kind of what I would call pre-development loans to get that going. And then the other side is land. There's all kinds of people sitting on land. And the trick with land is, well, it's okay, you're not going to step out and develop it right now, but at some point it is going to be, the timing is going to be right. So we're looking at doing land loans and, trying to say, okay, well, not now, but let's set it up for 1, 2, 3 years, whatever the number is, and get things settled until the market comes back. I think, one of the reasons the stock market has come back the way it is because people don't see the end of the world. What they see is there's some sort of a gap between where we are now and when we're going to be back to some sort of a more of a normalized situation. And your guess is as good as mine as to what that is. But I think everybody's trying to sort of factor in some kind of assumptions into that analysis and finance accordingly. So that's kind of the third category that I'd say we're involved in. So anyway, overall, we're reasonably satisfied with the way things are going this year.
Excellent. I think you've kind of touched on one of my lightning round questions already.
Good.
So that's good. All right. Well, I guess I'll just bring in a touch on the national perspective. And I'd say, it's been interesting to see the regional disparities. Before COVID, a lot of the markets were acting pretty harmonious in terms of how they were, the dynamics. There was a lot of tailwinds all over the place. People were tracking each other pretty closely. So as a tactical capital allocator, made it kind of, well, it was great. Everything was going forward, but it made it difficult to try and pick and choose. But I'd say since, to touch on the three stages here, I think the opening of capital flows and optimism has totally followed suit with some of the economic reopenings, albeit I'd say Ontario's opening was later than its optimism. But it's turning out pretty good. I saw the numbers today. They look fantastic for Ontario. And then I guess Alberta is went into it in a tough situation, long run, and it's really struggling there. And I think a lot of other national allocators are kind of seeing similar situations from the conversations I've had. But not to say it's completely down and out. But yeah, BC definitely strong amongst the bunch as well, and Ontario as well. Kind of shifting topics a bit, kind of pivoting over to another lovely topic that every lender itches to discuss, and that would be deferrals. This time, though, I'll ask Jim to start, kind of with a high-yield perspective from deferrals. I've seen a lot from the residential side that gets a lot of the news, but we don't really hear much on deferrals on the that kind of space. And then kind of shift over to Eric to chime in for some national insights, maybe elaborate a bit on that last slide of yours. So with now being about 5 months into the first shutdowns, how do you see those initial loan relief deferrals kind of playing out as some of them have expired or coming up to expiration?
Well, yeah, I'll sort of take a little bit more general approach. I kind of looked into this for another webinar I was doing a month ago, and the attitude toward deferral seems to be quite different depending on what sort of an institution you are. So I sort of canvassed a bunch of different lenders in various categories, and it seems like the banks and credit unions have been quite accommodating in terms of, I know one of the banks basically sent out a letter to all their commercial borrowers and said, you know, if you want it, you got it. That's all there is to it. And then it kind of goes down from there. The life insurance companies have been much more circumspect and really are having to justify a need, both in terms of the borrower strength and the tenant situation. So, you know, getting down to the private lenders, to be honest, you know, the private lenders I talked to simply weren't on for deferrals. I mean, if they're being asked to defer, they're considering it a workout. I mean, there's, you know, the private lenders are taking a little more risk generally, and you know, basically they want their payments, as far as I could tell. In terms of our own experience, we haven't even been asked for one. Nobody has missed a payment on any of the loans we've got. Obviously we're worried about that, but so far so good. So, you know, I think, you know, to the extent that I have the knowledge, the deferrals haven't really been an issue in the stuff I've been looking at. Just as a way of interest, I did talk to one of the larger lenders in the country at a fairly senior level, and his attitude was, if we run out of this period of deferrals, there's just going to be another one, because the government's just going to tell everybody, keep kicking the can down the road until we get this thing resolved. So, that's my comment.
Yeah, I would echo a lot of what Jim had mentioned there. Different institution types are taking different tacks. I'd say the banks and credit unions have been the most accommodating so far. At a high level, the numbers that we're hearing seem to be in around 15 to 20% of books have inquired about deferrals. As an overall number, usually 50%, a third to 50% of those are granted. Many of the inquiries were just groups looking to increase their liquidity situation, not necessarily something that was necessitated. Different institutions have used different tactics, from a 3-month period of no principal to 6 months. Some recoup the principal, some will just take it on the balloon balance. So there has been no true single way of handling it across the institutions. It's been a bit of a mixed bag.
Bill, would you agree with that characterization of banks and credit unions?
Yeah, I would absolutely. I mean, for sure within Vancity, but also in the other credit unions and banks that we've spoken to, there's definitely been a positive, accommodating approach. And to Eric's point, right, it's been 3 to 6 months has been the window that's been offered. It's been either principal deferral or sometimes the full P&I deferral. It really depends on the financial institution and the comfort level they've got. The one thing I think going forward, we're starting to see some of those 3-month payment deferrals come to an end, and we're seeing some asking for an additional 3 months. We're asking for a fair bit of extra due diligence to make sure that it makes sense, that they're just not wanting to, pad their pockets and just preserve cash flow, but there's an actual need to extend that out another 3 months. But we are seeing some very positive indicators that most that have the 3 months is coming to an end. They're able to start their payments again. There are even some that took the 6-month deferral option, and they're in a position where they're ready to start repaying as well. But I think the real test is going to be come October, November, when those 6 months, at least for us, we have a fair number within our business banking group that took the 6-month option. That's going to be the real test, because the government programs are slowly going to start to trickle away. And we've got a big chunk that are coming due October, November, and that'll be the real test to see what position they're in and are they ready to start making payments. And I'm hopeful the federal government is not going to kick the proverbial can down the street, Jim, because I think the 6 months has been a very fair option provided by FIs, and hopefully we can get just a few exceptions where we'll deal with those case by case on those businesses that have really been impacted and are still impacted come September, October, November.
Yeah, I think one of those industries has been some of the fishing expeditions by some of the borrowers out there. You can kind of pick them off about a mile away, but I think a lot of lenders are keeping separate little lists on how certain borrowers have kind of really treated the partnership relationship that we think, or at least from our perspective, the lender-borrower relationship, see how guys really do treat their lenders. It's been an interesting character call. It's been a struggle for most, and I think that the accommodations on the second round definitely play out on how they played through the first round. I definitely echo that. Okay, so as we continue progressing this through, I know it's a short panel, we're trying to cover a lot, but so now to a topic every lender really does like to actually talk about, which would be cash flows. This time I'm not talking about Jim's household spending habits, but more along the lines of underwriting changes that you've seen implemented. Maybe we'll kind of start with Eric from a national perspective, bring in some of this CMLS, but a broad platform across the country there. And then Jim, if you can follow on with Bill afterwards to kind of take this conversation into land and development pro formas, how you're seeing the changes within those sectors.
Yeah, so from a high level, generally whenever there's uncertainty, there's a flight to risk, and I'd say that the lending community definitely fits that same description. So whereas you would have seen an aversion towards retail and office currently, that's definitely kind of continued throughout. With regards to that, it's not all retail or office people won't lend on it. There's definitely certain types that are more appealing to lenders, but given a pause in lending, most of the lending community doesn't want to come in on certain asset types that are more in question. They're preferring the multifamily and industrial asset classes for sure. But even that said, industrial, it's nuanced in that certain small bay kind of hybrid retail are potentially a little bit more difficult to fund. We saw an increase in the requirement for guarantees as well. So whereas before, there was some leniency there, a lot of the lending communities would require that. That's tailed off a little bit over the last couple months as we've seen a stronger growth and more competition in the lending community. Another trend that we notice from underwriting is lenders wanting to deal with their existing borrower group. So take care of that borrower group first rather than taking on new borrowers. And that's just due to a familiarity and not wanting that uncertainty of how to deal with a particular borrower. So at a high level, I think I would characterize it as, a bit of a flight to quality, a flight to certain asset types, and dealing with familiar groups.
My turn?
Yeah, go for it, Jim.
So yeah, I guess talking about development land. So on the development side, I mean, everybody, lenders are kind of defensive beings to start with. So when times are a little uncertain, they get more defensive, which makes sense. So, I guess the main thing is people are looking at values harder and costs harder. And in terms of development, well, the only developments we're seeing, there's some office and other things under construction, but the majority of development loans involve condominiums or rental at this point. So on the condominium side, the issue, as I indicated before, is pre-sales. Difficult to get pre-sales. You're dealing with a homeowner market. So one of the things, there's a couple of things that lenders are looking at, willing to look. They're willing to do stage loans now, and in order to deal with low pre-sale thresholds. So in other words, you might have, maybe a $40–50 million loan commitment that starts off at $30 to $35 million. So the borrower's got some additional equity in at the starts. And then as the pre-sales come through construction, assuming they do come at some point, and gradually that equity is retrieved by the borrowers. And in some cases where there's additional equity required, we're stepping in with mezzanine financing to sort of fill that gap. And then basically we'll get paid out by additional advances from the construction lender. The other thing with pre-sales is I think there's some flexibility now in terms of deposit amounts. We're sort of looking at minimum 15% for frame and 25% for concrete. Well, concrete's kind of out of the picture, but I think on an exception basis, lenders are willing to sort of say, well, this purchaser seems to be real, and we understand that they can only put up 10%, and they're not going to increase that, and we'll live with that for a certain number of sales. So, that's kind of how they're dealing with the pre-sale issue. The other thing is, as Eric said, sponsorship's a huge issue. We hear all the time we're only dealing with existing clients. If you're an offshore borrower, if you're a new developer, if you're not too well heeled financially, you're going to have a much harder time, I think, these days than the sort of big 10 or 15 developers that are always going to be able to get financing. So that's kind of what I would say about development. On the land side, there's lots of shuffling around in land because lenders they have existing land loans they want to get out because they're not comfortable with values. And values, by the way, on land, we've seen situations where there's been an appraisal, property sells for, I'm just picking numbers out of the air, but $15 million. A year later, it's appraised for 30. A year later, it's appraised for 60, and then it's appraised for over 100. And we virtually just toss those appraisals in the ash can and try and figure out, on a development basis, what can a developer actually afford to pay for the land. So a typical situation right now is somebody, we've got one, in the downtown peninsula we're looking at right now where, an offshore buyer paid a lot of money for the land, have a ton of equity in it, and then have spent a further ton of equity. But right now, in the downtown peninsula, that's a high-end market. The high-end market's the hardest hit part. So you've got to find some way of saying, okay, well, what's my real value on this if somebody wants to buy it and develop it? And a lot of times we're reverting to, what's it worth as a rental site? Or what's it worth, or how long do we need to hold it? Is it 3, 4, 5 years in the downtown? Who knows? And what we're finding is a lot of times the existing lenders being paid out by a new quote unquote first mortgage, which might be in the sort of mid to high single digits. And but in behind that first mortgage, there's probably 1 or 2 or 3 participants. And you might have a piece of that that's done at 5 or 6%, and then another piece that comes in at 7, 8, 9%, and then another piece that's taking the back end risk. And sometimes that back end piece is taken by people who are essentially very comfortable with developers and are taking the attitude that if they end up owning it at the amount they're in for, then they're not at all unhappy at that outcome. So. Yeah, I guess that's about what I'd say on development and land.
Great. I think just to I'd love to argue with Jim and Eric, but I can't. But I think the flight to quality, absolutely, especially in land and development opportunities, is something we're focused on. And really dealing with that existing client. You've got a known entity, they've got a strong covenant, and it's I think we're consistent there. I think the only thing I'd perhaps add on the land side is, from a good news perspective and development side, I should say, is we're seeing some stability with costs, where labor and material costs are stabilizing. Where 2015 through 2018, they were both rising, pick a number, 5 to 10% a year. So that's a positive indicator. But yeah, agree with everything that Jim had said, so I'm not going to repeat it. I think on the cash flow side, I think this takes us back to March, which seems like 2 years ago, but that old fable, Chicken Little and sky is falling. I think most financial institutions, we didn't know where things were at. I mean, China was not in a good spot. The death toll in Italy was crazy. Stock market had crashed. Businesses were closed across the board. So there was a tremendous amount of uncertainty back in March, April. And because of that, I think ourselves and other lenders, you kind of turtle in a little bit, and you focus on your existing clients. You don't want to take that risk of bringing on a new client. And so, we for sure were a little bit more conservative on new opportunities, debt servicing, loan to value. We did a bit more analysis, because you're dealing with pre-COVID financial statements. You're dealing with pre-COVID comparables on an appraisal. So what is the rental price per square foot on Robson Street? Is it $80, or is it down to 62, or what is that number? So a lot of digging, a lot of further questions, and spending a bit more time on looking at opportunities. I think we've seen our kind of COVID lending guidelines have lightened up the last few weeks, last month or so. But for sure, we're gonna, for the immediate future, gonna continue to be spending a lot more time looking at future cash flow projections versus kind of looking in that rear view mirror and seeing what historical financials we're able to demonstrate. And just digging deeper. What are lease rates? What are vacancy rates? What are cap rates? And just having a good lens on that going forward. But for sure, positive indications that compared to March, April, May, our lending guidelines, we've absolutely taken steps to get back to not quite pre-COVID, but closing in on pre-COVID levels.
Yeah, I know, and echo a lot of those. There's so many kind of cash flow underwriting little levers you can kind of listen to a lot of what the appraisers are doing. They don't have the comps to change them certain things, so they're changing some of the micro levers, so to speak. Like, I know we're doing the same, like lowering your rental rollover assumptions, longer tenant turnovers, delaying inflation on a number of things, whether it be some cases expense, some are accelerated, and I'd say also just higher skepticism. To touch on your point on Robson Street, it's like the space absorption, who knows, add in some additional scenario analysis. And then I think one thing that I know we've done a fair bit is kind of digging through the borrower's portfolio a bit more with a negative lens, just to see where like the big domino might happen. Maybe not on the potential proposed loan, but just behind the scenes, just kind of that extra level of scrutiny. So I know it probably doesn't feel so good being a borrower these days asking for money, but you got to be asking for money at these cheap rates if you can get it. Okay, so I'm going to shift over to lightning round now here. And here's, you guys have a chance also to take some shots back at me. I know I've had some fun here, but feel free. So I'll try and go through, I'll list off your names, as we don't traditionally get to go left to right, and I'm not sure you guys see the same left to right or top to bottom that I'm seeing. So if you can answer as short as you can on these ones, and we'll cycle through. And I guess for the attendees, if there's any additional questions that you like, please just post them or direct message me on them. Okay, so to start off, easy first one, your prediction of unemployment rate or for Canada at the end of December 2020? Let's start with Eric.
Ooh. I'll go 7%.
7%, nice. Jim.
Well, I was going to say 7, so I'll say 7.5.
7.5. Bill.
7.25.
Oh, no initial bias at all here. Come on. All right. All right. In the scenario that the U.S. election shows that Trump loses, how many days until he concedes the election? Eric.
Yeah, I'll pass on this.
Pass. All right,
that's
next.
an option.
Jim.
I'm going.
Oh, God. Whether it's close. If it's close, it could be quite a while. But I don't think it's going to be close, so I think he'll concede right away.
Oh, right away. All right. Bill.
I'll say never.
Never. Going out in cuffs. All right. All right. Let's 2021 overall for the year, Canadian GDP growth. What's your forecast, Bill?
1.5.
1.5. Go to Jim.
4.
4. I like it. Eric.
I'm going 0.
Ooh, the optimist. All right. And outside of a COVID second wave, what do you see as the largest risk overall to the commercial lending space? Start with Jim.
Sorry, could you run that by me again?
Okay, outside of a second wave of COVID, presuming we're still in a surge of the first or like a true fall wave, what do you see as the largest risk overall in the commercial mortgage space?
I think the biggest risk is that there's a lot of tenants that are kind of hanging on right now, and they're with the combination of government programs and their own intestinal fortitude, they're keeping the lights on and the operation going. And I think if things don't change, a lot of those tenants could end up throwing in the towel, and we could have a vacancy problem, and that creates a what Bill was saying earlier, when you start looking at rents and what's a restaurant really able to pay in a new world. It probably is something less than he's paying currently. So I think that's going to create some issues.
All right, Eric.
Yeah, similar. I think once these government programs stop, I'm not sure the economy is on as solid as ground as people might be assuming. So really seeing how that transition happens is the biggest concern.
Bill?
Yeah, I mean, I think if I was to pick an asset class, I'd say retail. The future of retail in general is going to be a challenging one. Second would be office, just with the work from home, which we haven't really touched on today. But I think the key thing that we all need to have a look at is what both Eric and Jim have said, but looking at small and medium-sized business, right? They all got 40 grand seed, but they all got a cash injection, which for some small business is huge. And they haven't had to pay rent or mortgage payment for 6 months. So you take away their biggest expense. They're not paying their wages if they're on the wage subsidy program, and they got an influx of 40 grand. I think that's going to be the real one. What businesses are really sustainable post government subsidy and our deferral programs that we've provided? Because the negative implications there is those guys are also employing a bunch of the tenants for the multifamily that are paying rents for the mortgages we're financing. So that's the hands down the biggest thing we're keeping an eye on is small medium business and how they're going to be impacted going forward.
All right. Great answers, guys. Okay, I'll leave this one so you get a little bit of time to think about it. Your most embarrassing video call interruption since this all started. So I think I'll start with mine. And we were having a portfolio call talking about some maturities, and my 4-year-old was in timeout. And she started shouting loud enough to be heard over the microphone, I want out, I want out. And everyone on the call is going, yeah, I want out of the mortgage too. All right, Eric, go for it.
That's a good question. I think that the funniest one I've seen was a coworker that won't be named, started to do push-ups in the middle of a call just to get a little extra exercise, and thought the camera wasn't on. So it was everybody got a good chuckle. Too bad we weren't recording it, but I thought that was pretty funny.
Health and wellness live at CMLS. Like it. All right, Bill.
Yeah, I think probably mine. Unfortunately, it wasn't me, but we had a call with 80 plus people on the call, and the person leading it's got a, I don't know, 2 or 3 year old, and they lost it, and the person was talking at the time, so it was an entertaining minute before he found the mute button, I guess. But yeah, there you go.
Nice, Jim.
Yeah, I don't think I've had anything personally, although I do think I heard a toilet flush in one of them. So,
all right, bringing it back. Your prediction of the calendar quarter that the Bank of Canada will increase the overnight rate. Let's start with Jim.
I don't see that happening in the next year.
Well, what's your quarter? So you're saying not 2021. Which part of 2 or 23?
Q1 22.
Q1 22. All right, going to Eric.
Yeah, I'll say Q4 2022.
Again, the optimist. All right, Bill.
Yeah, I was going to say the same. So many factors, but Q4 2022.
2022. All right. Well, that sounds fun. All right. Going into what we now call the NHL playoffs. Now that I guess the Leafs don't get a first rounder right now. That's the latest news. But I guess the 2020 NHL playoff champions. All right. Take your pick, Bill.
I'm going to go with the Flyers and Alain Vigneault.
Okay, the Flyers. Jim.
Vancouver.
All right, the Canucks. And then Eric.
I'm a homer, so I got to go Canucks as well.
Canucks, nice. All right, I like this hometown. Okay, follow-on question. When do you think the next, quote, season for the NHL is going to start? Which month? Okay, Eric, start that one off.
I'll go February.
Feb. Okay, going to Bill.
January.
January. Jim.
January 15th.
Oh, specific. I like it. All right. All right. We're coming up to the end, so I'll finish with one that everyone loves and we're all wrong. Your benchmark spreads prediction. So name your benchmark, whatever it may be in the sectors. The spread prediction for the end of Q3 and then also the end of Q4. You guys can say what that is. All right. Bill started off on some of the construction stuff.
Construction, I think for good quality, we're going to see, prime 1.25 in that space.
Okay. Jim, kind of some of the benchmark mezz high yield kind of stuff.
Well, the concept of a benchmark on mezz is kind of ridiculous.
Okay, ranges.
We're going to get as much as we can. I can tell you that. Yeah, mezz rates and that sort of thing haven't really changed much. We're doing mezz loans in 10 to 12% range. We are doing some unregistered stuff at higher yields than that. We're doing some JVs that yield higher than that. So, but we're in the business of making money.
All right, keep at it. All right, and Eric, go for the conventional and Lifeco stuff.
Yeah, I think that the top quality stuff's going to hover around 200 for the next couple quarters, just given the underlying base rate is so low. I don't think we'll see it dip down to that 160 range 150, 160 that we're seeing at the beginning of the year. Yeah, so I'd say stay around 2%.
I unfortunately think it's going to go down to 175. I don't know. Too much demand, not enough transactions. I think supply and demand are going to skew that, unfortunately. Also, what I'm seeing on the triple Bs and A corporates, I don't like where those are going.
Yeah.
Means I don't get much yield there, so won't be playing there much. All right. Well, it's 12:58. I guess I'll throw it out, panelists. If you got any questions to ask each other, here's your last chance before we kind of wrap this one up.
No, I'm good.
Yeah, I'm good.
Nothing here.
You guys are too kind. All right. Okay. Excellent. Well, I think it'd be good to just kind of wrap it up and keep it in time here, as this is the first panel. I want to definitely thank all three of you guys, Jim, Eric, and Bill. It's been an absolute pleasure to have you guys on this inaugural webinar panel for the MIABC. You guys, I think, did a fantastic job. Much appreciate all your insights and all the opinions and background work that you guys do and bring to this forum here. And hopefully we can have you back on in the future. I wish you guys all the absolute best in your respective businesses going forward. You're all fantastic people. Thank you.
Thanks, Graham. Appreciate it.
Thanks
for hosting.
Excellent. And if anyone from the attendees has any questions that they didn't think of that want to ask, feel free to contact me as well, or any of us. I think we all like making new connections, and that's part of what the MIABC does. So feel free to use these opportunities to continue to do so. So thank you very much for taking the time to join us on this lovely sunny day, wherever you may be. And everyone have a fantastic day, rest of the week, and look forward to having you on to the next sessions for the MIABC in the future. Thank you so much.